Let's start with gold. Obviously, it's just on a rip every day, new all-time high. Where do you see it going?
Well, I'm not sure where it's going, but I suspect there's one level it'll at least see, and that's 8,500 area on gold. Now, there's a couple charts I sent you, and the first chart shows a logarithmic scale, a ratio scale chart of gold going back to 2015, 1975, excuse me, when the federal government allowed us to own gold again. Okay.
Yeah.
That was very nice of them. Anyway, we've had two major bull markets in that 50-year span with external conditions that are nowhere near the dynamite conditions we've got in terms of factors that could drive gold. Both were 8-fold moves in price, bear low to bull high. No matter what the price, the different duration trends. One was about 3 years, one was at 10. Okay, but the moves were the same, 8-fold. Our bear market low, last one was $1,046, $1,050 in 2015. Okay, we're only halfway the dimension of the upside of those two prior bull moves. You can see it on the log scale chart at the top, which is the gold chart. If we were to match those two moves, just on say we're going to do it again. Okay. Good, 8,000 plus gold. Okay, now that's just compared to the old bull market peaks. Now it may not stop there because these factors we're talking about are horrendous, especially government debt, not just here, but Japan, elsewhere. Yeah. That game is yet to explode in terms of its real world consequences. Mm-hmm. My own personal assessment and portfolio is emphasis on silver now. Okay. Silver moves with gold, but it sometimes lags, sometimes outperforms. Usually it lags. Now, this year it hasn't. It's actually up more year to date than gold is by a couple digits. Okay, so it's significant this year. But historically, it's still very low relative to gold. Like silver's trading at 1.125% the price of gold right now.
Mm-hmm. We do 80 to 1? It's still 70
no, we
to
don't
1,
do it that way. We divide an ounce of silver into an ounce of gold, express it as a percent. And if you go back over that 50-year span of time, we don't show it here, but silver in 21 of those 50 years that we've had has at least been 2% of the price of an ounce of gold, minimum. And in bull trends, like 79 to 80, or we're in a bull trend now, right? Okay. Yeah. Or in 2010 and 11, silver was 3% or more the price of gold. So right now at 1.125, silver is very cheap relative to gold, but it's technicals of that spread relationship. And we study it, week by week, month by month, and we run momentum of the spread. Momentum is now breaking out. It's telling us the spread itself that is rising, favoring silver since the beginning of the year, or especially since April, since April, sharply. It still hasn't broken out on the spread, but the spread, you get above 1.31% to get bean counting for you. Yeah. And we're headed toward that level. You're going to blow out like a 3-year high on the spread, in which case you're going to you're going to rush. Why is that important? That is the prominent indicator back in the 1979 to 80 surge, this final 6 months of that move. Silver had already been going up for years, so had gold. But suddenly in summer of 1979, that spread broke out of a situation that looks just like now. In other words, a potential breakout level, silver versus gold. It's at that point that the net price of silver, not just its relative performance, went boom off the page. I mean, it left gold behind. Gold was still rising, okay, but silver just went whoosh, okay. Exact same thing happened 2010. Like in September of 2010, silver had already been rising for years, so had gold. The spread broke out again. Said silver's, I'm back, okay. And by April of 2011, silver had gone from $28 to $50. From that point, we're at that cusp right now, where if you go through that level that I just mentioned, and 1. We're nearing, 1.31. You get above that, there's a vacuum between you and 2%. And that's not necessarily resistance. That's just a level we've been at 20 of the past 50 years, okay? So it's hardly exciting to get there. Yeah. But that is enormous. So that's why I'm emphasizing silver, because I think silver is vastly undervalued. And you could even see it on the price chart I've got there.
Yeah. And we'll show that chart. Yeah. I mean, is that how you know when to start taking profits and when to sell?
No, it's when if you're not in, where to initiate positions. Okay. I'm already in, and our subscribers have been handheld for the last years. We got bullish in February of 2016. 2.5 months off the bear low. Annual momentum of gold and silver said, it's over, I'm going back up. Nothing has changed the annual momentum of gold and silver, very long-term trend metric, okay? Nothing has altered that view. So it's been an ongoing bull for 10 years. And we're now at the point, I think, where the acceleration phase, the dramatic phase, where half the move occurs in 6 months, is about to occur. And I think for silver, it's likely to take us at minimum, I'm talking like sometime in next quarter, first quarter of next year, to 100. And if, on the other hand, in the first 3 months, don't be shocked if this happens, meaning 8, 9, 10, okay, if we get up near 100, then I think we're going to about 200. And
wow.
Well, no, it's not insane.
Because I mean, gold would be at 5,000-6,000 at that point.
Gold might be 8,000 by then, but if silver were 2% of $8,000 gold, let's say gold does the routine again. Okay, 2% of that's 160. Is that right? Yeah. Okay. I mean, you get the point. But also, when you look at the silver chart, it's very important because that log scale gold chart, I've got this red arrow going up over the 5 decades. It's been wave after wave, but higher and higher and higher. Silver, you could draw a line sideways through 1979, and we had 2 peaks at 50. We're only marginally out above that now. And so it's been caught in a 50-year range.
People often ask me where gold's headed, and I always tell them the same thing. I don't know exactly where it's going, but I can tell you it's not done yet. Because when you zoom out on a logarithmic scale, and that's key, not a simple price chart, but a ratio scale going all the way back to 1975, when Americans were first allowed to legally own gold again, you start to see the pattern. Gold doesn't move in random fits. It moves in great sweeping waves, massive bull markets that reflect equally massive shifts in global confidence. And in the last 50 years, we've had 2 of them. Both were 8-fold moves from bear market low to bull market high. And now we're halfway into the 3rd. Our last major bear market low was $1,046 in late 2015. Take that number and multiply it by 8. What do you get? Somewhere north of $8,000 an ounce. And that's not a pie-in-the-sky guess. It's simply repeating the rhythm of history. Each time the underlying conditions were less severe than they are now. Back then, we didn't have $35 trillion in U.S. debt, a bond market that's cracking, or sovereign balance sheets that look like ticking time bombs. Today, those external conditions are far more explosive. Government debt, monetary excess, geopolitical disorder. If we're honest, the fundamentals behind this bull market make the 1970s look like a picnic. What's fascinating is how predictable the crowd psychology still is. Every gold bull market starts the same way, quietly with a handful of contrarians buying while everyone else yawns. Then it builds momentum. The skeptics scoff, the charts break out, and then one day everyone suddenly realizes that gold is making new all-time highs day after day. That's where we are right now. It's moving like a freight train, and most investors are still standing on the platform, staring at the smoke. You could almost laugh at it if it weren't so serious, because this isn't just about price action. This is about the failure of paper promises. Every spike in gold is a vote of no confidence in the system. You can hear it in the tone of Wall Street commentary. Analysts whispering about diversification, fund managers suddenly calling gold a core allocation. They can dress it up however they like, but what they're really saying is, we don't trust the fiat experiment anymore. Now gold's doing what it always does when confidence collapses. It's repricing itself. But if you really want to understand where this is going, you can't look at gold alone. You have to look at silver, because silver is the wild card. It's the accelerant that turns a gold bull market into a full-blown monetary firestorm. Right now, silver's quietly outperforming gold year to date. It's up a few percentage points more, which is not much on paper but hugely important in context. Historically, silver lags gold early in a bull run. It plays catch-up later. But this time, it's been leading. That tells you the speculative energy is building. Yet despite that, silver is still incredibly cheap relative to gold. Let's talk numbers. At the moment, an ounce of silver trades at roughly 1.125% of the price of an ounce of gold. That's about an 89-to-1 ratio. If you go back over the last 50 years, silver has spent roughly 21 of those years trading at 2% or more of the gold price, meaning a ratio closer to 50 to 1. And in the biggest bull phases, like 1979 to 1980 or 2010 to 2011, it's gone even higher, hitting 3% or better. Right now, we're nowhere near that. Now, here's where it gets exciting. And this is where my work in momentum analysis comes in. When you run momentum studies on the spread between gold and silver, that is, the relative performance of the two, what you're seeing right now is an emerging breakout in favor of silver. Momentum is sharply turning up since April. If that spread breaks above 1.31%, it triggers a 3-year high. And historically, when that happens, silver doesn't just outperform gold, it explodes. We saw this exact pattern in 1979. Silver had already been rising for years. Gold was strong, everything looked stable. Then suddenly the silver/gold spread broke out, and within 6 months, silver went parabolic. It left gold behind. Gold kept rising, but silver tripled. The same thing happened again in 2010 to 2011. Silver had been grinding higher for years, but once that spread broke above its ceiling, it went from $28 to $50 in 6 months flat.
Once it goes through that 2%, to 3%, it doesn't last long up there. That's kind of what I meant.
That's the question. And this is what we're arguing. We think this is a shift to a new reality and price level for silver, meaning when you move out of this zone we've been in for 50 years, okay, and you go to $100, $200, you're not coming back to 50. You're going to live in a new range. Yeah, there will be sell-offs in that range, but the level has got to be sought out first. And frankly, you can look at a monetary degradation issue, like you mentioned, the money supply increase. Well, if you compensate for that, we'd be $200 easily. Okay. But there's some other charts I've included too that sort of smack you in the face. The next set of charts that I sent is 3 simple, stupid commodities. Okay. These charts are all from the Federal Reserve of St. Louis. Fred. Okay. Yeah. And one is the top chart is the price of lead. Okay. Going back to the late 1980s. In fact, you could go back to 1980 and you'll see that the first phase of that price action is the arrow on the left at a very low level. It just goes for decades sideways. It sort of looks like silver today, where it was in 1980. Okay. But look what happened to lead. It just suddenly went boom and quadrupled in price. Not because of a crop failure. Okay, we're talking a base metal here. Wheat can explode because of a crop problem, but a base metal doing this. And by the way, other metals did the same thing around that time. But it went to a new reality. And yes, then it dropped off again. But look at the new reality that's prevailed since then on the lead chart at a much higher level, horizontal for decades. Silver's still in the first range. Okay. Then the second chart's copper and copper products, as the Fed calls it. They incorporate products of copper. Same story. Multi-decade range at a given level. Then suddenly within a matter of about 6 months, you move into a quantum, to a new level, and you go sideways again, but at a whole new reality of price. And now copper's at all-time new highs, above even the 2011 high, which silver has only just done. Okay. The bottom chart is beef. Okay. Pound of beef. Oh. Look at what it's done since.
Don't get me started. Go to your butcher.
It goes up in layers and then it jolts and in a new reality. Silver's about to enter that new reality. And we know its fundamentals. We don't focus on that, but we know that they've been tight for years. They get tighter. Industrial demand is continuing to rise because of solar and the solar cell stuff. And also AI is creating a lot of demand because silver in micro forms is used throughout the whole system. And yet supply is not increasing. In fact, silver has a unique attribute in that most of the silver that's mined does not come from silver miners who are motivated, of course, by a rising price of silver. They come from people that mine magnesium or lead or zinc or copper. So, it might be a marginal issue for them to increase silver production because, frankly, it's just a byproduct of their copper production, et cetera. So they're not motivated by rising prices. Silver has a unique fundamental game. The question is, when is it going to do it? We think it's begun.
And you don't have a timeline specifically associated with that?
I think most of the profit-making phase of the shift, the easy part, is when that spread breaks out.
Okay.
And yes, I think it could be this month. Frankly, this week, if you close where you are now, the spread momentum is already breaking out on a weekly basis. But when you go to a monthly close, we wait for the end of the month. And if you're above that 1.31% level by the end of this month, which is no big deal, we could be there in 2 days, okay? Count on it.
When I look at where we are right now in the long-term wave of gold and silver, I see something that feels almost identical to the late 1970s. A moment when people could feel something enormous building beneath the surface, but couldn't quite put words to it. You know that hum in the air before a storm breaks? That's what this market feels like. The momentum is coiling, the pressure is visible in every metric, and yet the majority of investors are still sleepwalking through it. Let's talk about momentum, because that's where I've spent most of my career. Price is only the surface of a market. Momentum is the current beneath it. Momentum turns before price does, and right now, long-term momentum in both gold and silver is surging. The same pattern that marked the final explosion in 1979 and again in 2010 is emerging. Back then, traders thought the move had already happened. They looked at silver at $20 and said, well, it's doubled already, it can't go much higher. Then it tripled, twice. Momentum waves don't just tell you that something's trending, they tell you when it's accelerating. And acceleration is where half of the total move happens in the final fraction of the cycle. That's why I keep emphasizing, we are entering the dramatic phase. In my models, this acceleration phase typically compresses years of gains into months. That's what I mean when I say history moves in bursts. Silver is the perfect example. For decades, silver has been trapped in a 50-year range, topping around $50 in both 1980 and 2011. Now it's finally testing that ceiling again. But here's the crucial difference. Gold has already broken its ceiling. Gold's printing new highs. Silver hasn't yet. When that lag finally snaps, silver doesn't just catch up, it overshoots. That's how silver behaves every single time. It's the underdog that suddenly remembers it's made of dynamite. The ratio tells the story. At 1.125%, silver is still at a historically low percentage of gold's price. In past bull markets, that ratio pushed above 2%, and in some cases, even 3%. If gold just reaches $8,500, consistent with prior logarithmic moves, 2% of that gives you $170 silver. But remember, ratios aren't static, they overshoot. If silver spikes to 3%, that's $255. To most investors, those numbers sound insane, until you remember that it's happened before. In 1979, silver went from $6 to $50 in less than a year. That's an 8-fold move. Gold, meanwhile, tripled. People called that era a mania, but what they forget is that the fundamentals then were mild compared to what we're facing now. The United States debt to GDP ratio back then was about 35%. Today, it's over 120%. The dollar was still respected internationally. Now it's openly questioned by BRICS nations building parallel trade systems. Back then, global debt was around $5 trillion. Today, it's over $300 trillion. The same inflationary powder keg exists, but with 30 times the dynamite stacked underneath it. Momentum analysis tells me the structure is intact. The annual momentum of gold and silver remains in bullish alignment, meaning the primary uptrend is still alive, no matter what the day-to-day noise says. Every short-term dip has been bought. Every attempt to break the market only fuels more demand for the physical metal. That's why I call these self-correcting bull markets. The corrections cleanse weak hands and reload energy for the next surge. Now let's put this in perspective with some humor, because if you don't laugh at the absurdity of it all, you'll go mad watching Wall Street chase its own tail. Mainstream analysts still treat gold and silver as some relic from the Stone Age. They'll say, well, these metals don't yield interest. No, they don't. They yield truth. And right now, truth is the rarest commodity in the entire financial world. I often tell people, you don't need to trade metals. You need to understand them. When you grasp that gold is the measurement of confidence in paper, you realize every new high isn't speculative. It's diagnostic. Gold is the world's lie detector. Every spike is the market catching another lie told by policymakers. That's why these moves are so emotionally charged. You're not just watching charts, you're watching belief systems crumble. When the yield curve breaks, when government deficits hit records, when central banks pivot from denial to panic, that's when gold stops being an asset and becomes a mirror. It reflects the truth of what's happening beneath all the economic euphemisms. The interesting twist this time around is how the establishment is reacting. Normally, you'd expect the big banks and institutions to ridicule gold until the very end. But now they're joining the party, reluctantly. Jamie Dimon saying he wouldn't be surprised to see gold at $10,000? Morgan Stanley recommending 20% gold allocation? These are not fringe statements anymore. When mainstream banks start quoting the same levels that independent analysts were ridiculed for years ago, that's when you know the tide's turning. It's also why I believe the acceleration phase in gold could be even steeper than past cycles. We're no longer talking about fringe demand from contrarians. We're talking about institutional acceptance. And when the big money flows, the supply problem becomes existential. There simply isn't enough gold or silver to satisfy global reallocation from paper assets. Let's do some math again. Global above-ground gold is about 210,000 metric tons, but most of that isn't available. It's in central banks, jewelry, or long-term holdings. The actual tradable float is maybe 15% of that. Silver's even tighter. The physical silver market is roughly 1 billion ounces, $25 billion worth at today's prices. That's pocket change for global capital. If just one sovereign fund decided to allocate 1% of its assets to silver, the entire available supply would vanish. That's what happens when a tiny market collides with tidal waves of capital. It's the reason silver historically goes from dormant to hyperactive almost overnight. Once momentum breaks through that spread resistance I mentioned, above 1.31% relative to gold, the floodgates open. The algorithmic traders, the momentum funds, the speculators, they all rush in at once, chasing the same breakout. And because the silver market is so small, the moves look insane on a chart, but completely rational in context. We're also seeing the geopolitical catalysts aligning with this technical picture. De-dollarization isn't a theory anymore, it's a process. The BRICS bloc, led by China and Russia, is openly exploring gold-backed trade mechanisms. Central banks have been net buyers of gold for 13 consecutive years, accumulating over 1,000 tons annually. They're not buying to make a quick profit. They're building insurance against the death of fiat credibility. When I project gold to $8,500, I'm not doing it for shock value. That's simply an 8-fold repeat of prior bull cycles, nothing more. But I'll tell you what's different this time: the systemic scale. We've never had a synchronized global debt crisis before. The 1970s were a Western inflation problem. Today, it's a worldwide monetary disorder. Japan, Europe, China, the US. Everyone's drowning in unpayable obligations. And when debt reaches the point where it can only be paid by printing, gold becomes the only yardstick left standing.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.